Good morning and welcome to the Morton Brown Family Wealth Weekly Market Brief. I'm Katie Brown and I have Cody here with me this morning.
Good morning. How are you?
Good. So today is July 13th and we'd like to go through and give an update of where we stand today, talk a little bit about where the markets are at, but then also kind of cracking them open to see what's happening underneath the headline of the index. And also go into, inflation continues to be a top conversation for everyone in their home, outside of their home. We're all kind of talking about it and maybe look at some positives coming out of this and to see, are we starting to turn over a little bit? What are some of those indications that maybe we're on the second half, hopefully in the second half of this volatility? So with that, Cody, why don't you kick us off to kind of let us know where we're at and so crack that open a bit.
Yep. So as we were saying, this chart we actually have from Charles Schwab goes over where we're at year to date from an index standpoint. So on the left side, we have the S&P 500, which is a good indication of the overall index of the U.S., down around 18 to 20%. This is a week old, so we are down a little farther than when this chart was made, but we're down around 20% again so far year to date in the S&P 500. The NASDAQ, or the more growth-oriented index, is down around 26%. And then the Russell 2000 is down around 21% still year to date. And as you were saying, if we crack that open a little bit and we look at this fourth column, it goes over the average member and their maximum drawdown from their year to date high. So at their high of this year, how far have they came down at the low point from that level? And in the S&P 500, the average stock is down around, or at the low point was down around 30%. In the NASDAQ, the more growth oriented, at the low point was down around 43%. And the Russell 2000 was down around 41% at its low point. So in different cycles so far year to date, we've had some stocks go down a lot faster and then have a bounce back. And it's been all over inside of the indexes as a whole. The overall member has been hit or is declined a little more than the index as a whole.
Yeah, I think that's always surprising, especially to individuals, because those indexes, most of the indexes are weighted indexes. So the larger companies take up a larger portion, the smaller companies take up a smaller percentage of the index. So to kind of normalize that and then take a look at, all right, each one individually, how is it performing? And you really do realize it's usually a very small percentage of the companies within the index that are driving that performance, and that are kind of carrying a number of the other ones. And it also points to, we talk about this often, but the challenge in being a stock picker and selecting which one, because you have, in some cases, the majority of companies could actually be negative within that index itself. And it just makes it a very difficult area to find those winners.
Yeah. And I think another important column to look at is over the past 52 weeks. So at any point over the past year from here, not just year to date, but over the past year, the average NASDAQ stock is down 50% from its high over the last year. The average Russell 2000 is down around 48%. And then the average S&P 500 is down around 32%. Because obviously we know that the stock market doesn't move in yearly or in calendar years. It moves obviously at all times. Looking at the actual past year, the stocks have actually been hit a little harder than just year to date, which is pretty telling too.
Right. And just a reminder as far as what the indexes represent. So the S&P 500 being the U.S. large companies, and that's the broad, growth oriented, value oriented companies, but the U.S. broad companies. The NASDAQ is historically more the technology companies, or the growth focused. And so we expect to see a little more volatility there. That tends to be a riskier asset class. The Russell 2000 are the smaller companies. Same thing. We expect to see more volatility there. And that's a broad, index of smaller US companies, both growth and value, but just the nature of them, it's not surprising to see that the member drawdown is higher in the NASDAQ and in the Russell 2000 as compared to the S&P 500. It's just wanted to kind of remind everybody what's in there. So beyond this, something else that we often talk about and that we've been paying close attention to is like PE ratios and those price to earnings ratios, which kind of indicate what is the value, the potential future value of the stock that you may be purchasing. And so this chart here, Cody, if you want to walk us through kind of what we're looking at with this pretty colorful graph.
Yeah, hopefully this chart isn't too hard to look at. But the red line is, as Katie was saying, the S&P 500, which is the largest 500 companies inside of the US, which is that's the red line that you see on this graph. The blue line is the S&P mid cap index, which is the medium-sized companies inside of the US. And then the green line is the small cap, which is the smallest companies that we have that are traded on the stock exchange. So as we can see, we got close to not all-time high valuations back in 2021, but they were pretty high valuations, almost back to where we were at the tech bubble in some of the stocks. But if we look at the decrease that we've had in the PE ratios over the past year, we're actually down below where we've been any time pretty much over the past 7 years, going back to 2014, especially if you look at the green and the blue of the smaller companies inside of the US. We're almost back to where we were in the financial crisis back in 2008, 2009, which is pretty telling. And normally coming out of a downturn, the smaller companies are some of the first ones to turn coming out of that.
Right. And that's a lot of what we've been looking for over the last few years. I mean, it doesn't feel good to get to that spot, but we have been concerned, and we've talked often about the concern of the higher PE ratios that we were experiencing, up here in leading up to the pandemic, and then also in last year. Really, we still stayed very elevated, and so by those ratios coming down, what that's saying is that those valuations are getting back to normal. And in some cases, like you said, maybe even dropping a little bit below historical norms. So there's potential, greater value in buying. This is not the time to be selling necessarily and moving out of the market. You don't want to lock in these losses. And there may be an opportunity to buy at these lower levels. We don't know if it's going to go further down. It very well could. But I think there's more opportunity for growth as we look 6 months, 12 months out than we have had over the past few months. So it's important to keep in mind. One thing I forgot to mention at the onset of this is please feel free to put in any questions that you might have if you're thinking about things at this time, kind of what's happening in the markets, the economy around us, and you'd love to get our take on that. Please feel free to use that chat box to post questions, and we'll do our best to get you some answers. So, all right, so let's look at some other, Cody, a couple other things that we've been talking about. I know the Wall Street Journal had an article recently about dividends and buybacks. What are, what's happening kind of in that world?
Yeah, there was an interesting article that the Wall Street Journal put out both on the dividends and the buybacks that companies are doing so far year to date. And we're actually at record levels on both of those standpoints. And on the dividend side of things, they're actually expecting the pace of the dividend growth at double digits, which is the first time that we've seen since 2014, which is pretty telling that companies are feeling safe that they can raise their dividends at a double-digit pace and still feel that they're in a good spot. And then on the buyback side, where the companies are buying back their stocks, that again is on pace to be at a record level. So the companies are buying back their stock at a record pace, which is always telling that the company thinks that their stock is discounted to where it should be.
Mm-hmm. Mm-hmm. And I think I think it's important they're feeling confident and they want to demonstrate that confidence too. They, they want to show that they can increase that dividend and they're going to do, they're going to work their best to keep that dividend elevated, um, to really demonstrate their financial strength. And the buybacks, I think the buybacks can be a little bit confusing as far as what that means. So when companies buy back their stock, then there's less stock out there, and that can increase the value of the remaining stockholders that are there. So it's just another way for them to kind of give some value, I guess, back to the shareholders. But I think that is a good indication, and I, something else that we're looking at, we continue to pay attention to like jobs and hiring and in that world. And I think that kind of ties in here a little bit too, because these companies are growing and they do need to expand and they're still hiring, although some places sort of more than others. And so, the Wall Street Journal had another article recently and it was, where employers added jobs in June. And we found kind of some interesting, connections here with some things that we're seeing happening in the world around us. So, do you want to kind of touch on some of these graphs here?
Yeah. So the graph on the top left is from the Wall Street Journal, which goes over where we're at now compared to where we were at pre-pandemic. So in February of 2020. So we can see in certain areas where we're actually above where we were at pre-pandemic, which is the professional and business services, the information or IT technology services, trade, transportation. And one thing to point out here, we're above overall in the trade and transportation area, but a lot of these jobs, or the more positive where we've added jobs is in the warehouse side of things. We have more than 800,000 jobs added in the warehouse space to where we were at pre-pandemic. And then in the financial services, we're above where we were at pre-pandemic. But then there's services where we're actually below where we were at pre-pandemic, which is the education and health services, other services, and then the leisure and hospitality, which I know we want to touch on as we break down the inflation a little bit and how inflation normally reacts with the goods going first, and then hopefully that's starting to slow down, and then services starting to pick up. But then also we're still below where we were at pre-pandemic in some of the government areas. So the state, locals a little below where we're at, and then the government and the federal. But overall, we're still right around where we're at pre-pandemic as an overall job standpoint. It's just been added in different sectors. And that's where we see some supply chain issues in certain sectors, which I know we want to go over in this graph on the bottom right too.
Yeah. Yeah. And before we hop over to that graph, I think it's fair to recognize, there's still more job postings than people looking for jobs. But it is concentrated in certain areas. And some places are just struggling to bring those workers in. The leisure and the hospitality, they're just struggling to bring them in. But it's also fair to acknowledge that, and we're seeing, actually, I'm going to make a couple of comments here. There have been some really large headlines lately of large companies saying that they are not hiring freezes, they're laying people off. That's happening, but net, there's still more positive jobs being added. Even though those headlines are coming out and they're a little, they kind of perk they make you a little nervous. Anyway, but once again, still more job postings out there than people looking. However, we are seeing some of those job postings slow down. So they're still coming out. They're just not coming out at the same pace. So just want to, acknowledge that we may not continue at this same strong trend. But when we think about, are we in a recession? The payroll numbers, the job postings, all of that, granted, it's a lagging indicator, but it's still much stronger than we would expect. Like it's an odd pairing of what's happening in the markets versus what's happening in the job market. So I think that is a positive that hopefully we'll kind of keep a floor in there.
Yep. And I think
So,
one thing to point out that a lot of people are talking about too, that even if we are in a recession, hopefully it is a much milder recession because we do have such strong job numbers compared to some of the recessions that we've had in the past, where we've had much larger layoffs
mhm.
and hiring freezes, where we're still adding jobs at a great pace. So if we do officially get into a recession, hopefully it is a much milder recession and we bounce back a lot faster because we do still have such a good job. Like jobs are still being added, and it's we're still in a good space.
And for good or bad, spending is still elevated. I mean, credit card balances and just overall spending continues to stay on a similar track and actually higher track than it was before. And so consumers are not slowing down even in light of some of the inflation and some of the spikes, and it's amazing how strong travel has been given the spikes that we've seen in the cost of travel, which is what we want to, take a look at next and kind of draw some lines here. So what are those numbers down below?
Yeah, so this chart on the bottom right is going over where the prices are compared to last year, and then also before pre-pandemic on the airline side of things, and then also it breaks it down to food, to fuel, and then food a little bit on the bottom. So if we look at the airlines, I don't know if anyone's been looking at airline prices recently, but they are a lot higher, even where we were at beginning this year. But if we look at compared to where we were at last year, we're almost 40% above where we were at last year. And I was actually listening to the Delta CEO this morning because they had their earnings call, and he said right now they don't see any slowdown in the airline prices just because fuel prices are still very elevated. Demand's still there, and they're actually only operating still at 82% of their capacity just because they can't hire the people, which is what we see in this slide. So unfortunately, he said right now they don't expect any decreases in the airline prices, and I think that's majority because of this fuel. Obviously, we all know the gas prices have jumped a lot from where we were at last year, and then when we also look at the pre-pandemic, up almost 50% in the fuel prices for the airlines, and obviously with the increased demand, that's why we're seeing that the prices jump so much on the airlines.
Yeah. And even lodging, hotels up 22%. And those are areas that are struggling to hire. And so that makes sense that we're seeing inflation in those areas. Just the cost of it's greater because it's more difficult for them to deliver those services and be present and everything else. So all right. So from an inflation standpoint, I mean, obviously these are inflationary items, but then we're also still continuing to see inflation around us. Recognizing we haven't looked, but at 8:30 this morning, the new inflation numbers came out. We don't know exactly where they're at right now because we did not see as we've been on here. However, we're very curious to take a look at that afterwards to see if they're slightly higher, which they may be. It's the end of June and we're, a couple weeks into July, but I think there are some indications that hopefully we're peaking in some of these inflationary areas. And the forward-looking inflation projections are looking far better than they were a few months ago.
Yep. I did peek real quick, and unfortunately, it did come in a little higher than expected. It came in at 9.1% for June. But as you were saying, it is kind of we're obviously 2 weeks into July. Gas prices have come down a little bit. We're seeing in the commodity markets, which we're going to talk about a little more in this inflation slide. That's starting to come down a little bit. We are seeing the increase in services, so it's coming in different waves, which will be interesting, and hopefully the good side of things continue to drop. But as what this chart is going over, so this purple line is the 5-year tips to Treasury inflation. So the tips to the Treasury, the break even. So at the high of this year, we were looking at 5-year inflation expectations around 3.6% over the next 5 years. That's what they thought inflation could be, averaging around 3.6%. We have dropped significantly since those numbers, and we're down to around 2.5 percent now over the next 5 years. And if we look at the 10-year, which is the orange line, it's even further down around 2.3% of what they think the inflation expectations should be over the next 10 years.
Right. Right. And so this looks at like you said, that break even. So it's taking like the 10-year treasury rate, minusing out the 10-year tips rate, and figuring out kind of what that difference is. And so that's, as the Fed raises rates, those numbers, naturally kind of converge. And so this part of it is the effect of increased rates, slowing down the economy and hopefully slowing down some of the inflationary efforts, or the inflation that we've had. So, but I think this is a good indicate. I mean, we're still living in this inflationary world right now, but it is a good sign to see those numbers coming down, and the projections coming back to kind of more normalized levels at some point. And we can see it as we've continued to talk about. Certain areas are feeling that inflation pinch much higher, and that inflation much higher in certain areas. I think something that was interesting. So yesterday, Schwab had their monthly call, kind of monthly market call, and we had talked previously about. We've talked about bear markets in a lot of different contexts, different types of bear markets. One of them being the three bears of stocks, bonds, and real cash. And that's only happened where we've had kind of all of those areas down into bear market territory. That's only happened a handful of times in history. But as Schwab's team pointed out, the thing that has been kind of the trigger in coming out of like those three things together is when inflation starts to normalize. And so once again, we don't know where we're at specifically in this cycle, but I think there are some indications that we're hopefully in the second half of this, that we're leading more toward that normalization. So hopefully some of this churn, and once again, looking up in 6 months or 12 months from now, will be a very different marketplace than we have right now.
Yeah, I think that kind of, I'm not sure if you saw the question that came in, but it's asking, is it fair to say that we're in uncharted waters, meaning that we haven't seen what's happening right now in the market based on history? And that kind of goes over what you were just saying in those three different areas. There's only been a handful of times, not even a handful of times. I think it was 3 different times in the history that all 3 have been in a bear market at the same time.
Yeah, I think something that's really fascinating, and I'm stealing this for just a second too. I was listening to the Animal Spirits podcast this morning, and one of the items that Ben Carlson highlighted, he said, it's this past year and a half or 2 years has been like microcosms of different periods of history and different cycles. So, we had the pandemic was almost like Depression era activities that were happening at that time when everything, shut down. And then we had like the quick recovery. We had like almost more of like a small tech bubble that happened with, some of the tech companies that really soared at that time. And then we had, just like the roaring 20s, everything went up last year. You could buy anything. It didn't really matter what it was in the first half of the year. And some of these things, and then now, kind of moving almost into like the 70s. And so it's like these little microcosms of history that have all been condensed in a couple of years here. And it's fascinating. So there are things that we can point to historically, but to get the waves of them so quickly, it is uncharted waters. But I also kind of feel like it's always uncharted waters. It's nothing is ever exactly the same as what we've dealt with before. And the technology and the tools and the information flow and even like the Fed's approach to how they manage through with the tools that they have, all of that stuff is a constant evolution. And so, yes, it is uncharted.
Yeah.
Yeah. So I think those are a lot of the highlights that we wanted to go over today. Cody, I don't know if you have any, final thoughts as you're, looking up.
No, I mean, it'll be interesting. And I'm sure we'll touch on it next week in our quarterly market update. But there are a lot of important earnings coming out later this week and next week from some of the big banks. So it'll be interesting to see what they're saying when they're looking at obviously how the consumer is doing and what the consumer's done since their last earnings report. So it'll be interesting to see what those companies say later this week.
Yes, yes. And thank you for the reminder. We do have our quarterly market update coming up next week, Thursday, July 21st. So we'll touch on the markets, but then we also tend to go into the economy a little bit more and maybe talk about some things from how that translates to the individual investor and some things that might be helpful to do at this time. So go up in a slightly different direction from these conversations. And we hope that you can all join us for that next week, Thursday. And we'll look forward to seeing you in the morning then. So have a great week, and thank you for tuning in today. Take care.
Bye.